Source: imgflip. Introduction. First, let me be very clear that this is my personal portfolio tailored to my specific financial situation, risk profile, time horizon, and personality traits. I am not recommending anyone mirror this portfolio, which is merely designed to show my unique, rule-based, methodical approach to value-focused, long-term, dividend growth investing. My situation is unique, as though only 31, I'm already retired, medical retirement from the Army, thus making this portfolio an income-focused retirement one, though in a taxable account. I'm also working full-time, self-employed, and thus have an external source of income to continually add to this portfolio. I do not plan to actually tap the portfolio's income stream for 20 to 25 years, when I plan to move my family, and help support my parents, to the promised land of my people, retired dividend investors, Sarasota, Florida. What this portfolio can be used for is investing ideas. However, this portfolio includes high, low, as well as medium risk stocks, so it's up to each individual to do their own individual research and decide which, if any, of my holdings are right for you. For a detailed explanation of my methodology, please read my introductory article to the EDDGE, Eternal Daily Dividend Growth Experiment 4.0 portfolio. However, keep in mind that the portfolio is not static, and both it and the underlying investment strategy will evolve and adapt over time. This is because a changing world, new knowledge, and more experience will cause me to fine-tune it over coming years and decades to maximize my income and total returns. The reason behind owning such a widely diversified portfolio is because I've built this strategy using historical statistical analysis. Statistics requires large sample sizes to have any useful predictive power, and so, the more stocks I own, the more likely the long-term total returns are to approximate the projected returns. As a side benefit, it also creates a highly stable, bunker, portfolio that is likely to easily survive whatever future market storm might come. It also creates a stream of near-daily dividends which will allow me to compound my dividend reinvestment faster. Note that this experiment has to hit certain performance targets within a fixed time frame, break even within 3 years. Kevin O'Leary principle: if you don't make money after 3 years, it's a hobby, not a business. Match the market within 4 years. Beat the market within 5 years, on an unlevered basis. Beat smart beta ETFs that have historically outperformed the S&P. Beat all ETFs or smart beta ETFs, like QQQ, within 7 years. In case the portfolio fails to hit these targets, then I'll adapt it to add what is outperforming it. That means switching to an alternative plan, which tentatively looks like this: 25% QQQ, NASDAQ ETF, which I consider a superior index to the S&P. This week, due to family commitments related to Memorial Day weekend, there was no commentary. Next week, I'll explore at what level oil prices will start to pose a risk to the economy. The problem with perfection: my father recently asked me to give some advice to his friend about whether or not he should be investing in bonds, since interest rates are now rising and many people expect that trend to continue. My initial instinct was to recommend against bonds in favor of stocks, simply because over time equities have proven to be the best performing asset class. For example, since 1871, the S&P. That means that, roughly speaking, the stock market will double your inflation-adjusted wealth every decade. But then I thought deeper about this issue and I realized that I was making a common error that too many investors make. I was assuming that my father's friend was looking to maximize his total returns over time. More importantly, I was assuming that he could be a perfectly rational person, what economists call homo economicus, who would always be able to do the right thing. However, the reality is that humans are far from perfectly rational beings. In fact, we are often ruled by our emotions, which is why the perfect investment strategy is actually the one that maximizes your realistic returns over time. A perfect investing system might cost you dearly. Source: Slide Player. Humans are naturally very risk-averse. In fact, behavioral finance studies have found that in general we hate to lose a dollar twice as much as we enjoy making a dollar. Combined with recency bias, the psychological principle that people often extrapolate the recent past into the far future, this is what creates the market's natural boom and bust cycles. More importantly, it's why so many investors can't help themselves from attempting to time the market. Sure, buy and hold is great and a time-tested method. But imagine how great it would be if you could sell everything near the top of the market and thus avoid the next crash, and then buy back in near the bottom. Your returns would be much greater and your wealth would compound even faster, right? Sure, in theory. That's the basis of active asset management and what the hedge fund industry gets paid its obscene fees to try to accomplish. But guess what? Over the past 15 years, only about 5% of active fund managers have beaten the market. This is largely due to the nature of the fund industry, in which managers can't risk deviating too far from the market, closet indexing. It's also because during downturns, panicked investors withdraw their money, forcing managers to sell at precisely the time they should be buying. However, as bad as active fund managers can be, retail investors are far worse. In fact, over the past 20 years, the average investor's disastrous attempts at market timing, during the two worst market crashes since the Great Depression, resulted in not just underperforming the S&P. In fact, adjusted for inflation, the average investor has seen just 0.5% real returns over the past 2 decades. That's 10 times worse than inflation-adjusted returns from merely buying and holding a low-cost S&P. Which brings me back to my knee-jerk reaction to recommend stocks over bonds. Now, there is absolutely no question that over time stocks are far superior to bonds, at least in terms of total returns. In fact, since 1950, stocks have nearly doubled the returns of bonds. What's more, there has literally never been a 20-year rolling period when the S&P. That includes 1929 to 1949, which saw a 90% market crash, the worst in U.S. history. This means that theoretically the perfect solution for anyone with an investment horizon of 20 years is to be 100% in stocks all the time and ride out any crashes. However, there is a big difference between a perfect world and the one we actually live in. The ideal theoretical investment strategy is useless for anyone who doesn't have the stomach to wait out a potentially gut-wrenching bear market. This is precisely the reason why financial advisors recommend that most people own some combination of stocks and bonds. Yes, bonds are 100% guaranteed to lose to stocks in the long term. But they are also far less volatile in the short term. For example, since 1950, the worst year for bonds was -8%, while for stocks it was -39%, 2008. And a 50-50 portfolio of stocks and bonds? In 2008, that portfolio would have fallen 15%, or just 38% as much as the broader stock market. Thus, perhaps the most important principle for investors to realize is that it doesn't matter what the perfect strategy is. Rather, what you should focus on is what will realistically work best for you. Owning 50% bond ETFs is going to let you sleep well at night, or at the very least avoid making a disastrous move like selling into a crash. Then, this portfolio is far better than owning a pure stock portfolio whose volatility is going to cause you to panic sell. Now that doesn't necessarily mean that optimal personal asset allocation, what mix of stocks, bonds you should own, is easy to determine. After all, who of us can actually recall the visceral emotions we experienced during the financial crisis? I was in college at the time and recall watching the House vote down TARP the first time around on CNN, September 28, 2008. I had my portfolio open on my laptop and watched in wild excitement as the market began tumbling and didn't stop until the Dow finished the day down 7%. But while I may have been one of the few value investors eager to take advantage of such historic buying opportunities, I bought a ton of Apple, Nasdaq, AAPL stock during the crash. I remember that most people were not enjoying themselves at all. My father, for one, literally couldn't sleep for 3 nights. He was watching his 401k evaporate seemingly by 5% or more every day and feared losing everything. He ended up selling near the bottom, and to this day, his retirement savings have never recovered. For people like my father, even a suboptimal portfolio that included a lot of bonds would have been a much better solution than the hypothetical all-stock strategy that simply didn't fit with his psychology. Which is why I now advise anyone who asks me to try, as best as they can, to remember those dark days in 2008 and early 2009. If you want to know what investment strategy will work best going forward, try to create the most stock-heavy portfolio that you could have avoided panic selling during the financial crisis. Because at the end of the day, the perfect investment strategy for you is the one that exposes you to as much of the market's amazing wealth compounding power, but that you can actually follow given your own temperament. The state of the economy, aka recession watch. I use 5 key meta-analyses to track the health of the economy. That includes those which have historically proven to be good predictors of recessions: the yield curve, the bar economic graph, Jeff Miller's meta-analysis of leading economic indicators, the street, Lewis Fed's smoothed-out recession risk indicator, and the New York Fed's real-time GDP growth tracker. Source: Business Insider. The yield curve has proven the single most accurate predictor of recessions over the past 80 years. Specifically, when the curve inverts, or goes below zero, because short-term rates rise above long-term rates, then a recession becomes highly likely. It usually begins within 12 to 18 months. Yield curve inversion date: recession start date months to recession. Once curve inverts: August 1978, January 1980, the 17th of September 1980, July 1981, the 10th of December 1988, July 1990, the 19th of February 2000, March 2001, the 13th of December 2005, December 2007, 24, average 16.6. Source: St. Louis Federal Reserve. Ben Carlson. Current 2/10 yield curve, 0.48%, down from 0.51% last week. A few weeks ago, the curve fell as low as 0.41%, the lowest number since 2007. That 8 basis point increase is nice, but it's still too early to determine whether or not the curve is now steepening or merely trading in a flat range. Fortunately, history shows that the actual number isn't significant, and recession risk is low as long as the curve is positive. Overall, I'm optimistic that strong economic growth and rising inflation expectations should help to keep long-term rates rising over time and thus put off any potential inversion for many months, if not years. That's especially true if the Federal Reserve avoids hiking short-term rates too aggressively if the curve falls too low. The second economic indicator I watch is Economic Pie's baseline and rate of change, or bar economic analysis grid. This is another meta-analysis incorporating 19 leading indicators that track every aspect of the U.S. economy. That includes the yield curve through a different version of it. Source: Economic Pie. The bar graph has shown to be a reliable indicator predicting the 1980, 1990, 2001, and 2007 recessions. With 11 out of 19 economic indicators in the expansion quadrant, indicating accelerating growth, and 8 out of 19 still showing positive, though decelerating, growth, there remains little cause for concern. In fact, in the past week, 2 of the indicators switched to the expansion quadrant, indicating slightly better economic conditions. Source: Economic Pie. Note that 6 weeks ago, there were 12 economic indicators in the expansion quadrant, so the trend is still slightly negative but not statistically significant. In fact, the mean coordinate point, economic aggregate, remains at a neutral position, but about 37% above baseline. That's about the same level as last week. Next, there's Jeff Miller's excellent Economic Indicator Snapshot, a rich source of numerous useful market, economic data. It also provides an actual percentage probability estimate for how likely a recession is to start in the next few months. Source: Jeff Miller. What I'm looking at here is the quantitative estimates of short-term recession risks. In this case, the 4-month recession risk is about 0.73%, while the probability of a recession starting within 9 months is about 24%. While that is up slightly from last quarter, I don't consider it statistically significant. However, I will be watching inflation expectations closely, which drive bond yields, to see if the bond market loses confidence in the country's long-term growth prospects. For another look at recession risk, I like to use the Street Lewis Fed's smoothed-out recession risk indicator. This looks at the risk of a recession beginning in the current month. It's actually delayed 2 months. Source: St. Louis Federal Reserve. The way to read this graph is to understand that, in the past since 1967, as long as the reading, currently 0.1% recession risk, is under 18%, the economy has never been in a recession. This means that this graph can tell us with about 4-month lead time whether or not the economy is likely to be contracting. Finally, there's the New York Fed's real-time GDP tracker, historically far more accurate than the Atlanta Fed's GDP model. Current economic growth projections. Q2 2018 projection, 3.0%, down 0.2% from last week. Note that this is broadly in line with what most economists are expecting, 2.7 to 3.3% 2018 growth, and indicates continued strong economic growth. That bodes well for continued job growth, and thus, a continued tightening of the labor market that should eventually boost wages at a faster rate. Last month, private sector wages grew 2.9% YOY, which is up from 2.6% a year ago. That, in turn, could spur stronger consumer spending, 70% of the U.S. economy, and drive stronger corporate investment in earnings, cash flow, dividend growth. Master watch list. There are about 3,000 dividend-paying stocks in America, including special dividends and variable payers. This list has a goal of eventually listing all low, medium-risk dividend growth stocks that have the potential to achieve 10% total return potential. Target yield indicates approximately fair value, which is the most I'd ever recommend paying for a company, no matter how good it is. Total return potential is taken from the Gordon dividend growth model, which found that over time, total return for dividend stocks tracks yield, long-term dividend growth, a proxy for earnings and cash flow growth. The projected dividend growth is from either management guidance or the current analyst consensus. Finally, I've included a sector column because some investors, for various reasons, can't invest in MLPs. Bolded and bracketed stocks are at fair value or better and worth buying today. The order of the stocks is the order I recommend buying them in, assuming that maximizing total return is your primary goal. Ticker company target yield, fair value, current yield, potential long-term dividend, growth, total return potential, sector industry, AMGP, Antero Midstream GP 0.4%, 2.4%, 26.3%, 28.7%, MLP, no K1, oil, gas. 23.9% MLP oil, gas. 1.2%, 2.2%, 19.3%, 21.5% technology semiconductor equipment, HII, Huntington Ingalls Industries 1.2%, 1.3%, 20.0%, 21.3% industrial defense, CNXM Midstream Partners 5.5%, 6.9%, 14.0%, 20.9%, MLP oil, gas. 3.5%, 3.7%, 16.3%, 20.0%, right data center right, MA, Mastercard 0.3%, 0.5%, 19.3%, 19.8%, financial credit services, EOG Resources 0.4%, 0.6%, 19.0%, 19.6%, energy oil, gas. 1.3%, 15.6%, 16.9% technology semiconductors, UNP, Union Pacific 2.0%, 2.0%, 14.8%, 16.8% industrial railroads, Allegiant plc 0.7%, 1.1%, 15.7%, 16.8% industrial building products, AVGO, Broadcom 1.6%, 2.3.5%, 6.8%, 8.0%, 14.8% energy oil, gas. Products, Atlantica yield 5.6%, 6.0%, 8.0%, 14.0% Yieldco renewable energy Yieldco BA Boeing 2.4%, 1.9%, 12.0%, 13.9% industrial aerospace. 3.1%, 3.4%, 9.7%, 13.1% industrial diversified industrials, APD, air products. 0.8%, 1.0%, 12.0%, 13.0% basic materials metal. 2.0%, 2.3%, 10.5%, 12.8% consumer cyclical apparel, MRT, Medequities Trust 7.4%, 8.1%, 4.6%, 12.7%, Right Medical Right, AOS, Smith 1.1%, 1.1%, 11.5%, 12.6% industrial building products, TD, Toronto Dominion Bank 3.4%, 3.6%, 9.0%, 12.6% financial banking, GIS, General Mills 3.1%, 4.6%, 8.0%, 12.6% consumer defensive food. Old Republic International 4.3%, 3.7%, 8.6%, 12.3% Finance Insurance Core Energy Infrastructure Trust 8.2%, 8.3%, 4.0%, 12.3% Right Infrastructure Right PH Parker Hannifin 1.8%, 1.7%, 10.5%, 12.2% Industrial Diversified Industrials JKHY Jack Henry 1.7%, 1.9%, 10.1%, 12.0% Basic Materials Specialty Chemicals, EIG, Employers Holdings 1.1%, 2.0%, 10.0%, 12.0% Finance Insurance, FDS, FactSet Research Systems 1.2%, 1.3%, 10.7%, 12.0% Finance Capital Markets, SKT, Tanger Factory Outlet Center 1.9%, 1.9%, 10.0%, 11.9% Consumer Defensive Food 10.0%, 11.6% Industrial Aerospace 7.0%, 7.5%, 4.1%, 11.6%, right retail, right WDFC, WD-40 company 1.8%, 1.5%, 10.0%, 11.5%, consumer defensive household 8.1%, 10.8%, consumer defensive alcohol, GPC, genuine parts company 2.7%, 3.1%, 7.6%, 10.7%, industrial auto parts, PPG Industries 1.5%, 1.7%, 9.0%, 10.7%, basic materials, specialty chemicals, PepsiCo 3.0%, 3.7%, 7.0%, 10.7%, consumer defensive food 1.3%, 1.2%, 9.0%, 10.2%, technology electronic components, Manpower Group 1.6%, 2.2%, 8.0%, 10.2%, industrial human resources 4.1%, 4.0%, 5.9%, 9.9%, right apartment, right realty income 5.1%, 5.0%, 4.9%, 9.9%, right retail, right US Bancorp 2.5%, 2.4%, 7.5%, 9.9%, finance regional bank NHI National Health Investors 5.8%, 5.5%, 4. Carry 6.7%, 6.2%, 3.3%, 9.5%, right diversified, right FRT Federal Realty Trust 4.0%, 3.4%, 6.0%, 9.4%, right retail, right R Alexandria Real Estate Equities 3.5%, 2.9%, 6.5%, 9.4%, right medical office, right Deo Diageo 3.0%, 2.3%, 6.0%, 9.0%, medical pharmaceuticals, PSA Public Storage 4.9%, 3.8%, 5.1%, 8.9%, right storage, right VZ Verizon 6.0%, 4.9%, 4.0%, 8.9%, telecom wireless, internet PLD Prologis 4.2%, 3.0%, 5.8%, 8.8%, right industrial, right Essex Property Graphs, Guru Focus, Simply Safe Dividends, Google Finance. Note that the average yield, dividend growth, and total return potential are based on equal weighting of all 222 companies. If you weight by total return potential, as I plan to do, then the portfolio looks like this: yield 3.4%, projected dividend growth 11.4%, total return potential 14.8%. Note that those figures include even stocks that are too overvalued to buy today. In reality, the yield and total return potential should be higher if you avoid overpaying. Buys, sells this week: bought $1,600 of AAPL, target allocation $7,000. Bought my second tech stock last week, because even near 52-week highs, Apple is almost certainly going to beat the market over the next decade, potentially by as much as 63% per year. Plan for the next week. In keeping with this week's theme of Know Thyself, I'm changing up the way I deploy my weekly capital. While I'm very excited to buy a new stock each week, I've been frustrated by the fact that I've only been able to double down on stock I already own once a month. One of the core tenets of value investing is